Hi students, welcome to Sunil's tutorial. I'm Sunil Nirvani and today we'll be doing this chapter called as internal reco. Let's first see what do you understand by internal reco. Internal reco stands for internal reconstruction. Why do I need internal reconstruction and what is internal reconstruction? It can so happen that in the previous years the company must have suffered losses. Okay. Now the company feels that it has come up with a new product, or due to change in market situation or some unknown reason, the company feels that the future for the company is very bright. But the previous losses will not allow the company to move ahead. So there has to be some method to write off these previous losses. The method to write off these previous losses is called as internal reconstruction, wherein you have a board meeting and you have a settlement with your debtors as well as your creditors, stating how much you will pay them out of what actually had to be paid to them, and thereby writing off your previous liabilities so that the company can move ahead from here, the company can move on the path of progress from here. That's your basic theory of internal reco. Let us see sums based on internal reco. We are doing question number 1. We are doing illustration 1 in the books of Caton Limited. Let's see this. The summarized balance sheet of Caton Limited on 31st December is as follows. A scheme of reconstruction was approved by the court as under. Each existing equity share shall be written down from rupees 10 to rupees 4. Now while doing internal reco, there is only one rule that you have to remember. LAAL. If the liabilities are going up or assets are going down, then debit, I'll tell you what is debit. Assets going up, liabilities going down, credit, capital reduction. All these assets and liabilities that you are going to write off, to which account are you going to write off? You make a separate new account to write off these assets and liabilities, and this separate new account that is made to write off assets and liabilities is called as capital reduction account. Right? If liabilities are going up or assets are going down, then capital reduction is to be written on the debit side. If assets are going up or liabilities are going down, then capital reduction is to be written on the credit side. Do we understand this? Now let's see the sum. Let's go slowly with this. We are making a journal. They are saying that the existing equity shares shall be written down from 10 rupees to 4 rupees. The value of equity share is written down from 10 rupees to 4 rupees. So the value of share is going up or going down? The value of share is going down. Equity shares, if you see your balance sheet, is a liability. Liability going down. Liability going down means I should write capital reduction on the credit side. So my journal entry will be equity share capital account debit. Equity share capital account debit to capital reduction. Being equity shares written off or written down. Okay. Now, from 10 rupees to 4 rupees, that means each share is written down by 6 rupees. How many equity shares are there? Guys, your equity share capital, if you look at your balance sheet, is 10 lakhs. Each share is of 10 rupees. That means you have 1 lakh shares. Equity share capital as per balance sheet is 10 lakhs. Each share is of 10 rupees. That means you have 1 lakh shares. Each share is being written down by 6 rupees. So 6 lakh rupees. Do you understand how I got 6 lakhs? Each share is being written down by 6 rupees. There are 1 lakh equity shares. So this will be equity share capital account debit to capital reduction. Next, the existing preference shares are to be written down from 10 rupees to 8 rupees. Preference shares, liability, written down from 10 rupees to 8 rupees. Liability going down. Liability going down means capital reduction on the credit side. So this is going to be 10%, no, yeah, 10% preference share capital account debit to capital reduction. Right? It is being written down from 10 rupees to 8 rupees. That means it is being written down by 2 rupees my preference share capital is 5 lakhs. Each share is of 10 rupees, right? That means I've got 50,000 shares. Each share being written down by 2 rupees. 50,000 into 2, 1 lakh. Right? Being preference shares written off. They are written down from 10 rupees to 8 rupees, right? The existing 10% preference shares will go down from 10 rupees to 8 rupees, of which 4 rupees will be represented by 12% preference share and 4 rupees by equity shares. I have written down the shares. Next, out of that remaining preference shares, I am splitting the remaining preference shares into two parts. One will be called as preference share and the other will be called as equity shares. So whatever preference shares you have, I am taking that. Debit what comes in. I am going to take your preference share and now I will give you two parts. I am taking a preference share of 8 rupee. I will give you a preference share of 4 rupee and I will give you an equity share of 4 rupees. So debit what comes in. 10% preference shares will come in. Preference share capital. Instead of that, you will issue debit what comes in, credit what goes out. You are going to issue new 10% preference share capital and you are going to issue equity shares. Right? Now look at your preference share capital. You had 5 lakhs preference share capital, out of which 1 lakh has been written off. So that leaves you with 4 lakhs. Preference share capital account debit 4 lakhs. Everyone's understood this? Preference share capital was 5 lakhs, out of which you wrote off 1 lakh, so that leaves you with 4 lakhs. They are saying that half, see it is 8 rupees, it is to be represented with 4 rupees and 4 rupees. That means half has to be represented by preference share and half as equity share. Sorry. So this will be 2 lakhs and 2 lakhs. Being preference shares exchanged. Equity shares are written as equity share capital, right? Next, let's move on ahead. Each convertible debenture is to be exchanged for 50 non-convertible 10% debenture of 35, 50 non-convertible 10% debenture, rupees 35 12% preference share and 15 equity share. Exchange. If you are exchanging, you have to take the old debenture in, debit what comes in. So 10% debentures account debit. You are going to exchange it for what? You are going to be exchanging it for. You are going to be exchanging it for debit what comes in, credit what goes out. You are going to exchange it for new 10% debentures to 10% debentures. You are going to be exchanging it for debit what comes in, credit what goes out. You are going to exchange it for 12% preference share capital and you are going to be exchanging it for equity share capital. Right? Now, your 10% debentures as per balance sheet was 4 lakhs. Right? Now they are saying that 4 lakhs, that means you must have had 4,000 debentures. They are saying that each debenture is to be exchanged for rupees 50 non-convertible debentures. You have 4,000 debentures, you are converting them into 50 rupees each. So that is going to be 2 lakhs. You have 4,000 debentures and you are converting them into 50 rupees each. That will be 2 lakhs. And you are converting 12% preference shares into 35 rupees each. So you have 4,000 debentures. You are converting them into 35 rupees preference shares. Someone please find out how much is that going to be? 1 lakh 40,000. And you have 4,000 debentures. You are going to give them 1 equity share of 15 rupees each. How much? 60,000. Right, being debentures exchanged. Right. Next, let's move on ahead. IDBI Bank has agreed to apply for 5 lakh equity shares by paying full on application. IDBI Bank is applying. Now it does not matter to whom you are selling, so long as money is coming in. You are selling the shares. You are selling shares, so money is going to come in bank account debit. You are selling shares to equity share capital. You are selling shares of 5 lakh rupees. You are selling shares of 5 lakh rupees. Being shares sold. Right? Do you get this thing here? Next, the reduction of capital and reserves are to be applied for eliminating fictitious assets, and the balance to be used for writing down land and building and investments in the ratio of 3:1. Now they are saying that fictitious assets are to be written off. Let's see the fictitious assets you have. Reduction, eliminating fictitious assets. Now, the fictitious assets that you have on the asset side are goodwill and profit and loss. Assets written off. The value of assets going down. Guys, look at the rule. Assets going down means capital reduction should be on the debit side. Assets going down means capital reduction should be on the debit side. So this will be capital reduction account debit. Capital reduction account debit to goodwill to profit and loss. Right? So goodwill was 2 lakhs. Profit and loss is 4,20,000. This is 6,20,000. Right? Being assets written off. Right? Assets have been written off. Next, let's move on ahead. Okay. Now leave space for one journal entry. Leave space for one journal entry and make capital reduction account. Leave space for one journal entry and make capital reduction account. Right? Particulars rupees, particulars rupees. Let's look at our journal entries. In the first journal entry, capital reduction is on the credit side. In the first journal entry, capital reduction is on the credit side. Hence, the entry will be on the credit side. You will write by equity share capital. Equity share capital 6 lakhs. Right? Second journal entry also you have capital reduction on the credit side. Since capital reduction is on the credit side, you will make the entry on the credit side by 10% preference share capital. 10% preference share capital, that is going to be 1 lakh. Next, third journal entry, there is no capital reduction, no capital reduction. In the fourth one also, fifth also. Last journal entry, you have capital reduction on the debit side, so you will say 2 goodwill. Goodwill is 2 lakhs and 2 profit and loss. Profit and loss is 4,20,000. Right? Now, this is going to be, this is 7 lakhs and this is 7 lakhs. The difference is going to be 80,000. Okay. Now they are saying that the difference is to be used to write off land and building and investments in the ratio of 3:1. To land and building and to investments in the ratio of 3:1. 80,000 if I divide in the ratio of 3:1, I'll get 60,000 and 20,000. Right? So the balancing figure is used to write off land and building and investments in the ratio of 3:1. Now since land and building and investments are on the debit side here, when I transfer them into a journal, they will go on the credit side. So this will be, the journal entry for this will be capital reduction account debit, capital reduction account debit to land and building to investments. Right? Now, land and building is 60,000, investments is 20,000, total is 80,000, being capital reduction balance used. Fine. So that finishes the journal entries. Now let's see the balance sheet, guys. Liabilities, rupees, assets, rupees. Right? Now, let's see this. You have to look at your old balance sheet and make the new balance sheet. Now, I hope you all remember the rule for making balance sheet. The rule for making balance sheet is liability, add credit, subtract debit, assets, add debit, subtract credit. You have to make balance sheet in the format. So first you will have authorized share capital. Authorized share capital. Have they given you authorized share capital? No, it's not given to you. You could put a question mark and tally it off. Then you have issued and subscribed capital. Issued and subscribed capital. In that, first you will have 10% preference share capital. Preference share capital. Now, as per the balance sheet, your 10% preference share capital is 5 lakhs. Right? You have preference share capital on the debit side. So you subtract. You have preference share capital both on the debit and the credit side. Debit side is 4 lakhs. So you subtract 4 lakhs. Credit side is 2 lakhs. So you add 2 lakhs. Right? Besides this, I don't think you have any other 10% preference share capital, right? So this will come out to 2 lakhs. Then you have 12% preference share capital. 12% preference share capital, guys, is 1,40,000. Then you have equity share capital. Equity share capital. Now, as per balance sheet, your equity share capital should be 10 lakhs. Right? On the debit side, 6 lakhs. So you subtract 6 lakhs. Then you have equity share capital on the credit side, 2 lakhs. Add 2 lakhs. Then you have equity share capital on the credit side, 60,000. Add 60,000. Then you have equity share capital on the credit side, 5 lakhs. Add 5 lakhs. That's it. Right? So 4, 6 and 5, 11. 11 lakhs, 60,000. Right? Then you have reserves and surplus. Reserves and surplus. In that, you don't have any reserves here, and you have utilized all the reserves. There are no reserves in the balance sheet, and you don't have reserves. Okay. Then you have secured loans. In secured loans, you are going to have secured loans. You are going to have debentures. So you have 10% debentures. Now 10% debentures as per balance sheet is 4 lakhs. Right? Let's see debenture entry. In the journal you have on the debit side, so you will subtract 4 lakhs. You have on the credit side 2 lakhs, so you will add 2 lakhs. That's it, right? That's the only entry that you have. So your 10% debentures are going to become 2 lakhs, right? Next, you have unsecured loans not given to you. Then you have current liabilities. In current liabilities, the first thing that you have is bank overdraft. Right, bank overdraft is given to you as 3,20,000. We'll write it here as 3,20,000. Just in case if we fall short of cash, we will use this. So this could change. Creditors. Creditors is 3 lakhs. Then you have bills payable, which is 50,000. Then you have provision for tax. Provision for tax is 1 lakh. Right? Okay. Let's move on ahead. Those were your liability sides. Asset side, fixed assets. Fixed assets, goodwill. Goodwill as per balance sheet is 2 lakhs. Right? You, for assets, the rule is add debit, subtract credit. You have goodwill on the credit side, so you will subtract this. So minus 2 lakhs. So this will become nil. Then you have land and building. Land and building as per balance sheet. Land and building as per balance sheet is 10 lakhs. Land and building as per balance sheet is 10 lakhs. And land and building is given to you in the journal as 60,000 on the credit side. So this will be 9,40,000. Right? Next, furniture. Furniture as per balance sheet is 1,25,000. Furniture as per balance sheet is 1,25,000. I don't think you have a furniture entry. No. So you can straight away write that outside as 1,25,000. Next, investments. Investments were 4 lakhs. As per the balance sheet, you have investments on the credit side 20,000. So minus 20,000. So this will come to 3,80,000. Right? Then you have current assets. In current assets, you have stock. Stock is given to you as 2,80,000. We haven't done anything with stock. Then you have debtors. We haven't done anything with debtors, so you write the amount as it is, 2,20,000. Then you have bills receivable. Again with bills receivable, nothing, so 25,000. Profit and loss. Profit and loss 4,20,000. And in the balance sheet, you have profit and loss on the credit side 4,20,000. So profit and loss becomes nil. Then you have bank. Now let's see the bank figure, guys. Bank, you have bank on the debit side 5 lakhs. Bank on the debit side 5 lakhs, so that will be added. Right? That's it. That's the only one entry that you have. So bank on the debit side 5 lakhs. Now, guys, in this case, some authors say that if your bank balance figure is more than your bank OD figure, then the bank balance is to be utilized to pay the bank OD. Either way, you keep bank and bank OD in your balance sheet, or you use the bank figure to pay the bank OD. Just in case if you do that, then your bank figure would have become 5 lakhs minus 3,20,180, and you would have had to pass a journal entry for that. That is bank OD account debit to bank. Either way you could have done it, right? That's the last thing that you need to do is tally the balance sheet and complete the sum. 24 lakh 70,000. Balance sheet tallies. Both the sides. 24 lakh 70,000. Right? That finishes the sum. We'll stop this here for the day. Thank you very much.